Financial markets can be divided into two markets, the money market and the capital market. Lesson 2.1 deals with the money market. We will look at general characteristics of money market securities, as well as some particulars of certain money market securities. There are some characteristics that all money market securities share. One of these characteristics is that they always have less than 1 year to maturity. The second characteristic is that they are highly marketable. This means that it is easy to sell this type of security to other investors. Because this type of security has a short term to maturity and is easy to sell, it is also considered highly liquid. This means that not only is it easy to sell, but when you sell it, you can do it quickly and without significant loss of value. Usually, large institutional investors are the main purchasers of money market securities. Large institutional investors include pension plans, investment funds, insurance companies. These investors purchase money market securities for their portfolios. Money market mutual funds is one way that smaller investors can purchase money market securities. We will focus on 4 types of money market securities. These would be the most common money market securities for individual investors to be involved with. The first one, federal government or Government of Canada T-bills. Next we will deal with GICs, which stands for Guaranteed Investment Certificates. And then finally we will deal with commercial paper and bankers' acceptances. Each of these securities are dealt with in more detail in the coming slides. T-bills, which is short for Treasury bills, are the most marketable of all securities. This is because Treasury bills are backed by the federal government of Canada. This means that there is very little risk that the issuer of these investments will be unable to pay the money that is required at maturity to the investor. Treasury bills are sold at a discount to par. Par is the face value of a Treasury bill. When the Treasury bill matures, its face value is paid to the investor by the issuer. Because Treasury bills pay no interest, they are always purchased at less than par. This means that a $10,000 T-bill would always be purchased for less than $10,000. This difference between the purchase price and the maturity value is the customer's earnings. Again, because Treasury bills pay no interest, this is the only earning that a customer receives on this type of investment. Treasury bills are sold by the Bank of Canada on behalf of the federal government in order to raise funds for infrastructure and services. The last piece of information on this slide refers to the calculation of the rate of return on a T-bill investment. Because the T-bill pays no interest, the only earning on a Treasury bill is the difference between what you pay for it and what it matures at. So the calculation is as follows. You take the maturity value or the par value of the T-bill minus the purchase price, which gives you the total amount of money that you've earned, and whenever you are calculating a rate of return, you divide by what you invested, which in this case is the purchase price. The rate of return, or yield, that we just calculated on the previous slide gives us the rate of return for the period of time that you have held the T-bill. For instance, if I purchased a $10,000 T-bill for $9,800, I would calculate 10,000 minus 9,800 divided by 9,800. This would give me the rate of return for the amount of time that I held the T-bill. So for instance, if I purchased the T-bill and it had 40 days to maturity, my rate of return would be a 40-day return. This is good information for me to have as an investor, but when I have this type of a return, it makes it difficult for me to compare my T-bill investment to other investments. The reason for this is because other investments provide a rate of return on an annual basis. All rates of return on other investments are reported on an annual basis. For this reason, we actually do 2 other yield calculations for T-bills. Both of these calculations annualize our rate of return calculation that we previously did, because T-bills have a time to maturity of less than 1 year. Therefore, our rate of return calculation on a T-bill will always be for a period of less than a year. We want to annualize that so we can compare it to other types of investments. The two yield calculations that we do are the bond equivalent yield and the effective annual yield. You will see in the next two slides how those calculations are done and what the difference is between the two of them. The bond equivalent yield is the most common yield calculation to be done for a Treasury bill. This is because this is the yield that is reported in the newspaper. When you open up the newspaper and you look at the 3-month, 6-month, and 9-month rates of return on T-bills, these are bond equivalent yields that are reported. Basically, what we are doing is we're taking, for example, our 40-day T-bill return, and we're figuring out if we did that investment and we invested every 40 days until 1 year was up, what would our equivalent return be? This calculation uses simple interest only. It doesn't take into consideration any of the earnings that you receive every 40 days. Only the fact that you're making the same investment over and over again for 40 days. The calculation is at the bottom of the slide. We take the same calculation that we've done before, the maturity value or par value of the bill, minus the purchase price, divided by the purchase price. In the next step, we multiply by 365 over the term. The term is the number of days that you have until maturity. So in our example, 40 days. By dividing by 40, we're taking our rate of return and dividing it by the number of days it took to get that return so that we now have a daily return. Then we multiply by 365 to give us an annual return. This will result in a decimal answer. We multiply by 100 to give us the percentage return. The effective annual yield on the T-bill is another way of calculating an annualized rate of return for our T-bill. In this case, we are taking into effect the compounding of the earnings. With the bond equivalent yield calculation, we calculated on our 40-day T-bill the result if we had made the same investment every 40 days without reinvesting our earnings. With the effective annual yield calculation, we are calculating the rate of return if we made the same investment every 40 days and reinvested our earnings every time. The calculation is in the middle of the slide. We take 1 plus the maturity value of the T-bill, or the par value, minus the purchase price divided by the purchase price, and all of this is to the power of n. This is because we are compounding these returns the number of times that we will be reinvesting during that 1 year. So n is the number of compounding periods in a year. Using our 40-day T-bill example, we would take 365 divided by 40 to find out the number of 40-day periods in a year. This would be n. All of this minus 1 will result in a decimal answer, which we will multiply by 100 to give us the yield in percentage terms. GICs and term deposits are two money market instruments that share a number of similarities. They are time deposits where money is invested for a set period of time, locked in at a set interest rate. GICs tend to be for more than 1 year and term deposits for less than 1 year. A GIC becomes a money market instrument when its maturity date is less than 1 year away. Both types of deposits are CDIC insured. This means that they are insured by the Canada Deposit Insurance Corporation. CDIC insures deposits against the risk of the insolvency or bankruptcy of the financial institution where that instrument has been purchased. The maximum amount of coverage on CDIC insurance is $100,000 per person per institution. Both GICs and term deposits are non-transferable. This means that they cannot be sold from one investor to another. The contract must be held until maturity and then cashed in. The only time that this is not the case is when the investor dies, at which time the cancellation of the contract is possible. All of this does not take into consideration GICs that are now in place with special terms and features that may allow for early redemption or early cancellation. The next two money market instruments, commercial paper and bankers' acceptances, are related to one another. First, we will deal with commercial paper. Essentially, a large company, when they require funding for a short period of time, can approach a bank for the funding, or they can issue this type of short-term unsecured debt and sell it to the investing public. This is a short-term investment, and it is sold at a discount to par. No interest is paid on this type of investment to the investor, and again, it's for a short period of time. Once the issuing company has issued it and an investor has purchased it, these types of securities can then be traded between investors on the secondary market. We'll talk about the secondary market in later lessons. Bankers' acceptances are very much like commercial paper. They are issued in the same way by large corporations. The only difference is that in this case, a bank has endorsed the commercial paper. So in addition to having the issuing companies promise to pay a certain amount of money on a certain date, you also now have the bank's assurance that that money will be paid. In essence, you have the bank's backing on that commercial paper.